There are clusters all over the place today on multiple indexes and multiple sectors. A lot of extreme signs, bullish, but extreme bullish signs and signals that are showing up across multiple indicators, multiple charts. So I'm going to break all that down, what that means, and how likely that might be to produce an exhale type move to the downside. So I'm going to break that down. I'm also going to break down why I'm not with as bullish of a move as we've had off the COVID low. Why it actually isn't as bad of a thing as I thought it would be when we first started. When we first started off of that low point. So we're going to break that down, and then I'm going to take a look at a trade idea on a very popular stock that's showing us some bearish patterns showing up, creeping up here this week, and we'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, September the 2nd, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we got another cluster. So, boy, we're getting a lot of these clusters here. This is the second cluster on the current near-term run. Again, the clusters, the overbought clusters, they don't line up like oversold. You can get oversold like back to back to back to back. And these all, you can see these two occurred on the same run. And if you look over here, like these two occurred at the end of this near-term run, all in the same near-term run. These were separate near-term peaks. But this one was the beginning, and could this be the end of this current near-term run? That's the idea behind this current. And the other difference too behind this one and these other two clusters that we've gotten. Now again, remember, we're nearly 5 months along into this intermediate rally, so very mature to say the least. The typical time frame is 1 to 3 months. So to be 5 months, almost 5 months, is very mature. So to get clusters on mature trends is an overbought cluster. If you can get them at the beginning, great. That can help really solidify. Like we almost got one right here. That helps really solidify the potential for this to really take off and get going right when you get into the upper reversal zone. But when we've already been in one, and especially kind of since we've been so long without even light pink shading here, then it brings up that possibility, and again with all four lines being above 80, that we are closer towards the end of this intermediate run than we are the beginning. Hopefully, right? I mean, 5 months long. We're not going to go another 5 or 6 months. We might go another month or two. But, again, this kind of parabolic move we're getting and the kind of blow off top move that seems like we got here today suggests we might be a lot closer to the end of this intermediate run than we think. You can see the Dow Jones also getting us the Dow Jones is also getting an overbought cluster here. And as well as it's getting closer to this 100% line, its pre-COVID highs. The NASDAQ not getting a cluster because of the long lower shadow we got today, which is kind of rare for it to get a long lower shadow, which can be bearish. Long lower shadows can be bearish. They're not as bearish as long upper shadows are. As you can see, you got one here and you got one over here. And remember, too, you're not going to get very long shadows at the top of a bullish move because the VIX is relatively low compared to at the bottom. You tend to get very long shadows at the bottom of moves. And then, of course, look at the Russell 2000. Interestingly enough, also getting a cluster. and it hasn't been an outperformer to say the least. But in fact, we just barely had light pink shading yesterday. Today we barely turned back, the intermediate line barely turned back up, but it did turn back up above 80 with a very strong showing on the short-term sentiment, rising long-term line, but not anywhere close. It's still struggling to get past the 78, but at least it's still holding the 78% Fibonacci level. So clusters all around, overbought clusters all around. It's not too often that you get clusters on all these indexes, especially like the Dow. As different as the S&P and the Dow and the Russell are in terms of what they cover, and again, not getting one on the NASDAQ is just simply a function of that lower shadow, that the low point that we had earlier today kept the momentum line down. Otherwise, had we opened up at the low and finished with this type of range, that would be a very bullish sign. So strong patterns, and you can see, even on the weekly chart, not quite getting the cluster there on the weekly chart, but you can see the S&P 500. Here, let me go to a weekly chart. On the S&P 500, you can see very strong near-term line up to the 98th percentile, way up above. We saw today in class, in our options inventory class, this is like historically high. And there hasn't been, since all the way back to like 1933, we haven't been this high above the 30-week moving average on the S&P, and of course, looking at the Nasdaq, you can see something similar. And the Russell 2000 has even turned green on its weekly chart, interestingly enough. So, while we might be overbought right now, it doesn't mean that any long-term move is done, right? In fact, the intermediate line's just barely gotten above 80 here. We might be trending higher for a while. It took a couple, it's been a couple of years on some of these intermediate runs. This was over a year on that one. And you can see if I go back out further, you can get good long intermediate rallies here, like this one lasted for quite a while, and I think there's the opportunity for something like that to come out of this current move. All right, before we go into some other charts here, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video there. There's also a little bell next to that subscribe button. If you click on that bell, that will notify you on your phones or any other notification when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, you want us to do another video again tomorrow. It's a quick way to give us feedback. That's our only survey for these videos. So if you like our videos and you want to let us know, you can do it with one click right now while you're watching. If you don't like our videos, of course, don't click on anything. And we can kind of get an idea of what you all think about our videos down there. Also, too, comment. What questions or comments do you have about anything I talk about in the videos, or what stood out to you in today's video that maybe you weren't thinking about, or you hadn't or heard about or seen before? Post those in the comment section below, and you can be able to share your thoughts and ideas with other Market Outlook viewers. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our website, we invite you to check out some of these other things here over to the right, including our Market Outlook Live video. Our Market Outlook Live is where I manage all the old Market Outlook trades that we've done, the trade ideas I give you in these videos. I manage all those trades, and then I also put on today's trade before the market closes. So we've actually already done that for today. So if you're interested in that, again, that's available for all of our subscribers. Our Plus and our Premium subscribers get access to that. They also get access to all of our trading rooms. Our Premium subscribers get access to our Q&A sessions, as well as all of our premium tools and communities where all of our custom content are. And you can be able to interact with other market scholars that are attending the different classes here. All right. We also invite you to hit this heart. It opens up a new window. Hit that like button right there. Hit this thumbs up. It opens up another new tab to your Facebook page. Hit that like button right there. Again, the more you do that, the more people will see our stuff. In fact, you can see here, I have like, a couple thousand or close to a couple thousand or over 1,000. A few hundred more people who like my page, yet only 100 and some odd people see the post. So the more likes are on these, the more of our followers will see our content. So that's why we always ask for it. The other benefit to you is Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, so now if we take a look at the chart here, it's interesting to see we're actually getting bigger and bigger candles, and you can see the PPO just rises so high. Again, one of the highest levels that we've had in a while here. If I were to edit this, and where are we at here today? It's 7.2203. That's how much we've gone up, because I think I changed it to that number at the beginning of the week. So very higher than where we were in January. But another interesting development compared to where we were in January is the candles are getting bigger. That's not generally the case. Generally, you just kind of, go up and down, up and down. The candles don't really get bigger, but you can see we did that in here too. We also did it here. And when you get the bigger candles at the end of a run, in a mature intermediate run, that can lead to smaller candles and red candles on the Hakinyashi basis. So especially when we're this high, again, for some perspective, over the last 20 years, this is about as high as we get. We got this high back here when we started this big head and shoulders pattern and the credit downgrade. The PPO, we got this high over here, and we went for about half a year of no moves in 2004, where we retested the 200-day moving average. So again, we're very, very high on the PPO with increasing size in the candles is a little bit of a red flag there. And you can see the Russell 2000, that's not the case. We are getting smaller candles after a couple big breakout candles here to get above to catch up, right? We had to catch up because we were so far behind. Whereas the NASDAQ 100, again, you can see big time candles kind of blowing off. And again, you thought the S&Ps was hot, PPO was high. You can see we're at 15.5 here on the NASDAQ. And again, you go back over 20 years, including this move. I mean, like, we haven't been this high. This is very significant. And if you look at the price axis, let me put the log scale. So you can see we're kind of going a little parabolic here according to the PPO. Now that's not, we've been this high before. So if I go to 1990, we were actually higher than this. So to the 90s, you can see. But in the early 90s, the mid where we really started to take off, we didn't get it. It was really this kind of blow off move at the beginning of 99, and especially this one where we went nuts at the end of 99, beginning of 2000, all the way up to that March. We were nearly 30%. The 50-day or 10-week moving average was nearly 30% above its 40-week moving average. So, but since then, you can see this is about as high. This is the apples to apples move too. This isn't like the MACD. Very significant. And you see that those signs of maturity all across the board. I mean, the DMI is up to 46. It's not as high as it's been. It got up to 50 during the COVID low point, but it is as high as we've been for any like highs. If I were to put this here at 46.29, just to kind of give you an idea. So now you can see again the negative we got higher, but let me go out further so you can see just how high this is on a daily chart. Again, that we got this high there on the negative. We got this high here on the fourth quarter 2018. We got higher than where we are now at the January 2018, which shows just how crazy that move was and how parabolic we went. We got close to this high in 2010 before QE2 was announced. And then again, you can see now during 2008, during the bear markets we had. So there's really been only one other time in the last 20 years we've been this high on a bullish move, and that is January 2018. And that kept going, right? We don't know. That was the last time we had a 5-month-long intermediate rally. One of the only times in the last 20 years we've had a 5-month-long intermediate rally. And again, you saw how that resolved itself, especially with, again, you go back there. That was the last time the negative index was so low below 10, and the positive index was way up here. And in fact, it's jumping up to about, itself up to about 46. The positive index looks like it's at, let's see here. Yeah, right about 46.29. So right about the same level as where the ADX looks like it's actually at 46.09. So almost right on top of each other there. So very mature trend, to say the least. And then you look at like the RSI, and you can see well up above 80 on the RSI, and the CCI is diverging. You can see on the weekly chart, we're almost above 70. So that's kind of interesting. Not nearly as strong as we were again in 2018, where the weekly RSI got up to 90 on that blow-off move to the upside. And even over here, pre-COVID highs, The weekly RSI got up a lot higher than where we're at right now. On the SPX, on the NDX, different story. The NDX is up to 80, and that is a sign, that it's, again, this is the leadership too, that it's kind of run, it's very mature in its trend. You can see the Russell 2000, interestingly enough, can't quite get above 60 and stay above 60. The CCI did get above 100, but the RSI can't quite get going through the 60 level, and that's when you have a hard time being bullish, right? And we've talked before that this bear market that we've been in, this stealth bear market, started at the beginning of 2018, really kicked into gear here. You can see the RSI from that point. We were easily above 60 and stayed above it during this bullish move. You can see never got below 40 here, and then we got below 40, and then we weren't able to get above 60 at all pre-COVID a little bit, and then boom, well below 40, and now we're back to 60, but again unable to really get going here. So the RSI is showing us on the broader scale we're not really trending still. It's still just a function of the drop. In fact, if you take away the drop, we're still at the same levels as we were in early 2018 for that matter. All a very, very sideways action with some volatile drops in the middle of it. All right, now let's take a look at our intraday, and you can see we gapped up early, gapped up pretty significantly early, and then you can see we had a lot of volume pretty much all throughout the day, a very big jump in volume at the end of the day as we rallied on the news of a vaccine by November 1st. Again, it's so fascinating to see, like 331's our low, and we're going to have a low point here in this area in the next couple of days, right about 332.90. So we're going to move this up a smidgen, but still, that's a 27. That's after we moved up the low point significantly to this level. Now we're up 27 points, nearly 10%, and again, the rubber band typically stretches on bullish moves 5%, and so we're really stretching. We have stretched. We're really, the only time we don't stretch as much, but still very far stretched, is when we move up that low point. But we've really pushed up the high again to very high levels, to the point where we are way up above the value area, and the point of control is way down here at 338. That's $20 away, and there is like hardly any volume that can stop us from getting to 338. For whatever the catalyst may be, there is nothing that can stop. Like, it can get down there very quickly, very rapidly. I've always mentioned to you that we can fall from 0 to 23% and go up and down between 0 and 23% very, very easily without skipping a beat. Right? Well, right now, that 23% level is at 324, roughly 324. The 8-day, if I didn't show you these, that 338 level is above the 30-day moving average. So it's below the 17, but it's above the 30. 324, again, the 23, and this has, I need to activate and move this up to this new low. So there's where the 23% retracement level is. Well, but like, we can get down there very, very easily. We can get to 338 and 340 without even breaking the 30-day moving average. Might not stay down there, but we can get down there very easily. So, and especially with the lack of volume support, because essentially since August the 24th, it's been free sailing. In fact, if you take a look at how things have performed since August the 24th here, August 24th up until now, you can see with a little bit of a jump higher at the beginning of the day on the 24th, there's that gap higher. We're up, over 5% on the S&P, almost 7.5%. Even, all these equities are up 2%. But look how much of a gap there is between IWM, which is typically the higher beta name, than there is QQQ even. Huge difference in such a short amount of time. And long-term bonds, which have been down, they've been rallying the last few days. So it's interesting to see how there's been some strength in safety trades over the last little bit. And that kind of goes into volatility. I mentioned last week, or before last week actually, I mentioned that post-August expiration, we should get a jump in volatility. And that's been the case. On an absolute basis, it's been the case. We jumped up from, after a little bit of a drop, to 21.5 or all the way up to 26.5. It's a big jump in volatility. But on a relative basis, as you can see down here, it has not gone up. In fact, we're still near extreme lows. We have been all day near extreme lows despite the rise in volatility. And the reason why is because the VIX 3M is rising just as much, right? It's up to 32.67 now. So that kind of gives you an idea of, why volatility is just not really going anywhere, even though it's been rising. And I also mentioned too that one of the signs to see that we might be starting an intermediate pullback is a gap down to the downside, close to at least one standard deviation gap to the downside to start to at least fill in this gap. Look how big that gap remains. Historical volatility is rising a little bit. ATRs are rising, historical volatility is rising, but there's still a pretty decent gap. And at some point in time, we're going to get a little pop here, and that's what's going to bring historical volatility up too. And that pop will start with a down day and pretty much an opening gap to the downside. So very interesting patterns in volatility. And I mean, if we're already up from 21 to 26 without us even getting to 90%, then by the time we get to 90%, the VIX is probably going to be, which is not an intermediate pullback, right? That's just kind of a near-term pullback, maybe down to like the 17-day moving average. So a jump to 90% is going to easily get us into the 30s. A jump to an actual intermediate pullback that has a jump to 100% on the volatility is going to get us probably to the mid to high 30s, if not closer to 40. And I didn't think that would be the case, but the fact that we're rising so much already without a move at least into the upper half of the bullish zone is a little interesting to say the least. All right, we'll take a quick pause here and just summarize our technical outlook. Obviously, we're still got a strong trend, but now, there's been some kind of signs and cracks before, but now we're getting signs of extremes. Like bull markets don't die of old age. Bull markets don't die from a lack of buyers. There's always plenty of buyers. There's always money coming in to the markets through retirement plans and whatever. So bull markets won't die, but bull markets do die of excess. They die of excess greed, and we're starting to see signs of that, signs of just extreme bullishness that we've seen in the past, and they resolve with normal pullbacks, but those normal pullbacks may not be very comfortable if you are going long like right now, or if you've been going long over the past few days with significant. It continues to be a time to take advantage of days like today to reduce risk, reduce exposure. We had one of our trades in our class portfolio long that was actually a September expiration that we kind of monitoring, and it kind of blew up today. And it's like, okay, this is a good opportunity here to roll that and reduce our exposure, reduce our deltas, reduce our exposure in that opportunity. And so things like that, reducing your deltas, your positive deltas. We've been doing that in the market outlook video. We've been doing that in our class portfolios, and more days like today just make you more. You don't have to go bearish. You don't have to short the market. You don't have to be bearish in your overall deltas, but you also don't have to be as strongly bullish anymore as you had to be, a few months ago because of these mature extreme signs that we're seeing. You're kind of getting a little bit of a warning beforehand that you can be able to take advantage of. So what do you think? Do you agree with that? Do you disagree? Let me know down in the comment section below, especially if you disagree. What are you seeing? What signs are you seeing that thinks we've got a lot more runway left to go to the upside, or that you think we're getting more than just a little exhale to the down, more than a normal exhale? No, it won't be so little, but it'll just be a normal exhale. We might be headed for the end of a bull market. Whatever your disagreement, let me know as to what drives that, what chart or indicator you're looking at, and share that down below. All right, now let's talk about what's driving. I kind of brought this up a little bit, and this is actually a chart that I saved here so I can show you. Give me 1 second here. I heard on TV today that there's more than just a few stocks that are driving this market higher, and that is hardly the case. I'm actually a little surprised that they actually said that, because if you look at the equal weighted S&P 500, I tweeted this out Look at the equal weighted. Even this week, we're at the lowest level that the relative strength of equal weighted S&P has been to the S&P. That's not typical for bull market. See all these runs higher here on this ratio? This is a ratio now, not just the S&P itself or the equal weighted index itself. It's a ratio of the equal weighted index to the S&P. And you can see during all these bullish moves, it typically goes up until we hit the election of 2016. And that's what this chart represents. So this chart here shows from that point, from post-election 2018 up till now, you can see there, the Qs have really blasted up 153%, nearly 3 times the return of S&P as a whole, right? So then this, of course, the Nasdaq. Most of the Nasdaq 100 companies are in the S&P, not all of them, like Tesla, for example, but most of them are. And then look at down here, IWM is only up 14.5%. And this is a 4-year period of time. So 1, 2, 3, almost 4-year period of time that you only got a 14% return on small cap stocks. And it includes a drawdown nearly of 30% from that high point. And at one point in time, S&P or IWM was up 25% before coming all the way down to negative levels. It got down to an 8% decline there and was down for most of 2017 before finally taking off there at the end. So, really this has been the FANG stocks and anything related. And now lately with some other big NASDAQ 100 names that are working their way up that market cap weighted ranking within the 100 stocks there. But that's what this chart tells us, and we see it even worse in the NASDAQ, right? In the NASDAQ equal weighted index compared to the regular NASDAQ 100, it's even worse, and we are at extreme lows. Look at the PPO down to extreme lows. We saw that in the fourth quarter of 2018, going into that quarter, and that's when we had a decline. So you can see the upward moves are actually kind of bearish. There's a little bit of a bullish move. This was a bearish run on stocks, a relatively bearish run coming from the credit downgrade. You can see that negative. So this is, and you can see here again the bear market starting in the fall of 2018. But now we're even worse. Like we're at a really significant downward move. There's the global slowdown in 2015. The MACD is down to really low levels. And obviously, when this thing turns around and goes back up, it won't be because we're bullish. So it has been and continues to be the leadership in the market, and that's okay. And I believe it will actually continue to be the leadership in the market going forward from here over the long term, 1 to 2 years. I expect us to have good returns. And one of the reasons why, I'm not as worried as I thought I would be when we got back to these levels on the markets. After the COVID low point, I thought, if we jump right back up without testing lows, that's not going to be a good thing. But it actually hasn't been a bad thing because it's only been a handful of stocks. As the strength in these stocks doesn't lead to sharp underperformance, but does lead to, the strength does start to filter down, not to significant outperformance in these other areas, but to some bullishness in these other areas so that they can kind of help catch up to where these other stocks are leading the way, then we're going to be bullish for, like I said, maybe a year, 18 months, 2 years. But in the short term, and it's like short to intermediate, we are extreme, and these continue to show extremes, and we're seeing that all across the board. And if I just look at just today alone, so let's come here to a custom chart and just look at today here. Pull back down to September, and then just let's look at this week, this crazy week that we've been having so far. You can see there's the strange bedfellows, the QQQ up 3.5% on the week, the S&P up 2%. Small cap stocks getting a late surge here, even though they were down for most of this week until now. And then you can see down here, you can also see the dollars up this week. So gold down because of the strength in the dollar. Was up actually early on the safety trade, but today's move in the dollar strongly to the upside kind of pushed it down. as well as emerging market stocks, you can see have been struggling with this kind of risk off move initially, and then this dollar strength here today. So this is not the most risk on chart, and to see that the long-term bonds are also continuing to show that strength again, and I've shown you this before, and here's the other reason why I'm not so concerned about us being back to these highs, is because we haven't seen the weakness in the safety trade. The safety trade remains strongly overbought and continues to push back up even as we speak over the last few days this week. So we really can't get going and get a good bid into, because again, when we're close to like the end of bullish long-term runs, this is going to be oversold, not overbought. So we're still got a long runway to the upside, but again, we might pop up here in the short term back up to these strong levels again before, and maybe even triple top by the time we roll over and get going on that risk appetite trade, and the risks and the safety trade finally sells off. And I've shown you gold before, this chart here before, and we've talked about how strong gold has been, but when you look at like for example copper, and copper's been very strong relative to gold. But if you take a look at copper, like it's been going up on an absolute basis. Here, let me show you on the absolute basis here. It's been going up on an absolute basis, looking very good, very strong, coming off of its lows, COVID low points, closing above the 2019 highs at the beginning and early of the year. So good, strong performance on an absolute basis. On a relative basis, we're up off the COVID lows. We're not anywhere close to getting above those 2019 highs. Not anywhere close. We're not even above the 200-day moving average of the relative strength, and these lines aren't even positive yet. They're rising, but they're not positive. So again, gold's got a long way to go to sell off before, relative to other riskier elements, right, that are more associated with risk appetite, like copper, economic growth. RSI still easily below 60. And so when you start to see some of those things happening, then we're on our run. Obviously we still have a lot of long-term potential, even if we are so extreme in the short term. All right, now let's take a look at our sector rotation. And I wanted to bring this up today because, again, this was a common refrain here. If you take a look at what's leading the market higher, and you can see we got clusters on 1, 2, we actually came really close to getting one staples. It was on throughout the day, but we had 4 sectors give us overbought clusters today, and almost a 5th one was staples. But look at you can see, like, compared to pre-COVID highs, XLK, XLY, XLC have blown away those pre-COVID highs. Energy, not so much. Financials, not so much. Industrials, even with the cluster now, not so much. And materials, a little bit higher. Staples, a little bit higher. Healthcare, a little bit higher. Not to the same extent as the 3 cyclicals up here at the top. And obviously utilities and real estate, interest rate sensitive areas. You would expect with yields as low as they are that they would be more bullish than this, but they're lagging too. So again, it is a handful of companies, and even these sectors are very market cap weighted too. So you're looking at Amazon here, Facebook and Google there, and Microsoft and Apple there, and those are what those 3 are, because they're so their market caps are so high, and they dominate those. They dominate the S&P as a whole, but they definitely dominate their individual sector ETFs. So it's not as broad as people on TV would like to say it is. When you look at some of these other major economies out there, you can see very similar patterns. Like, again, pre-COVID highs. Japan getting a cluster today, but not, it's not above its highs. China is kind of right around at its highs. Its pre-COVID highs. That was actually about a month earlier than what the U.S. was here. Let me pull this up too, so you can see that one. So there's the U.S., but you can see like India, like look at Italy, France, UK, way below its pre-COVID highs. Canada down. Russia is actually rolling over here, and it's got light pink shading and a yellow line. Italy, light pink shading as well. Korea is kind of matching its pre-COVID highs, but not there, and Brazil way down below. So obviously, again, not even abroad from a total global market standpoint. It's large cap U.S. Mega cap tech names that's driving risk appetite as a whole right now, all across the board in terms of regaining its pre-COVID levels. Because you remember, again, that's the SPX. You look at the index, and that's how much it's above its pre-COVID highs compared to everybody else here. All right, that brings us to our trade idea of the day, and it's a big name. It's one actually we have a trade on in our class portfolio from Directional Option Strategies, but I wanted to look at another trade to kind of go along with it here, and that is on Apple. You can see the big bearish engulfing pattern it's gotten. Even after rallying off of the lows today, it still finished with a pretty significant engulfing pattern here. What stood out to me on this chart was we ended up with here, let me bring up Apple. We ended up with about a 2% decline. It's not our first 2% decline. We had plenty of these others, but every single one of these other drops all started off with small declines, opening gaps to the downside, very small. This is the first one where we actually had a pretty significant gap to the upside. We gapped up over 2.5%. And then finished down 2%. So that's and you can see its volatility has been rising here on Apple as we go forward with its historical volatility starting to come up off of a higher low. You'd expect to go up to a higher high as well. So its volatility is really picking up. Expected moves are expected to be bigger and bigger, and that's coming off of some really mature patterns that I've been pointing out on the broader market as a whole, but it's already been showing up on Apple itself. You can see how high its ADX got on a positive trend, and you can see the moves in the individual indexes going in the opposite direction now. The CTI has been diverging with these highs since the split was announced, and especially these last couple of highs that have been well above 80 on the RSI, so very mature patterns. You see it on the weekly chart as well. Apple got up, and you can see the long upper shadow too. And we've still got 2 days left in the week, and we'll see how that plays out by the end of the week. But there's, you can see the rally we've made and how far we can go down before we even hit for Fibonacci support, much less any kind of significant volume support. As you've got some, at the 23, just below between 23 and 38, there's a little node. There's even smaller node before you get to the 23, before you get to a bigger one, which is here at the 50% retracement. I don't think we'll get all the way down to that level, but I think you can get down to the bottom end of this node here, this volume node, and not really skip a beat, especially with the bandwidth starting to roll over to the downside, which means we can fill in that bandwidth. It's still a very high bandwidth. When you have a high bandwidth, you can fill it in. Like over here is a really high bandwidth, and we reversed it while it was still high. So here is the same thing, but in the opposite direction. You'd expect to reverse the bandwidth in the opposite direction there. You also see too on the Ichimoku cloud just how far up above the cloud we are, how far above the price. The red line is above price, way up there, and how strong trend quality is. Very, very mature. And we're starting to see little signs of reversal, at least candlestick signs there on the weekly chart as well as on the daily chart. You can see too its PPO is at an extreme, even for Apple is at an extreme level. And then you look at its 3 green arrow chart here, and you can see similar divergences setting up on its stochastics with very, very high MACD, and even with today's engulfing, still above the 8-day moving average. So, okay, well, if we can do a bearish trade on this stock, let's take a look at its options chain, and we'll go out to October. You say, okay, well, with the trade that we have currently set up on, an iron condor type trade that we have set up, and there's risk to the downside element of the condor, then we can do a small little long put vertical spread where I buy this way out of the money put, 115, sell the 112.5 to offset the cost of that, and it gives me this volume profile here. Let me get rid of the, let's get rid of the iron condor, and just take a look at the vertical. Oops. Sorry, it's this one right here. Sorry, it's this vertical. And there's our vertical spread. So, and we're already, it's already moved a little bit since we got into it after, before the market closed. But, for a few $100 of loss, because if it goes right back up, then we can close this out for the $200 loss. But to help offset the potential of a downside move for our condor, it gives me a pretty decent reward for a few $100 of risk if we were to fall all the way down towards that support level. If you want some more color on this trade idea, check out the Market Outlook live video where I dive into it a little bit more, and you can see the setup and the strikes and everything else. Alright, well that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That opens up a link to our Market Outlook forums. Even our free subscribers get access to that. The rest of our community is for our premium subscribers, but our free subscribers do get access to our Market Outlook forums. Open up any new thread, reply to anybody else's thread, and let's keep this conversation going in between videos here. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon on Twitter and on Facebook too, and then comment on our video. Join our website, join our community at marketscholars.com, as well as the community we've created on Facebook. And join me on Twitter at DavidSettle42 at my handle there for any content in between videos. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.